Good morning and welcome to today's webcast, the year-end tax update for technology, communications and media, and life sciences companies. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Good morning. Welcome, everyone. Thanks for joining our annual year-end tax update for technology, communications, and life science companies. We do this webinar every year to help remind companies of the year's evolving tax issues. As you will recall, we started off the year with significant changes due to the passage of the Tax Cut and Jobs Act. Since then, Treasury has been working to provide implementing and explanatory guidance. We've received some of that guidance so far, but there's still a lot more needed and expected. Also, during 2018, there was a significant Supreme Court case that drastically changes companies' state tax exposures. Today, we'll go over some of those changes that will impact technology, communication, life science companies. We can't cover them all within an hour, so we're going to address the most common issues. My name is Richard Croghan, and I am the tax leader for our Technology, Communication, Life Sciences Industry Group, and I will be your moderator. Joining me today will be Seung, a tax partner out of our Silicon Valley office, Cline, a partner in our state and local tax services group, and Shannan Gardner, a tax partner out of our Orange County office. Today, Seung will cover a number of the items that will be different this year on your 2018 tax returns and calculations. A lot of these changes relate to how international operations will be taxed by the U.S. this year and going forward. Then Adam will cover the new world of state taxes, the Supreme Court decision in Wayfair, and the legislative changes in light of that decision is creating many more tax issues for all types of companies, both in their sales and use tax and in their income and franchise tax. Lastly, Shannan will talk about how all of these changes and some other regulatory changes will impact your year-end tax provisions and disclosures. To start off, as mentioned in the intro, to qualify for CPE, we are providing a number of polling questions so that you can get the appropriate CPE. And our first polling question is, what is your biggest concern with 2018 taxes? Is it the changes from tax reform? Is it the international changes specifically within tax reform? Is it the state changes due to Wayfair? Or is it accounting for income taxes, which is always a complicated area and one that is scrutinized in your audited financial statements? So we'll give everyone a little while, 10 or 20 more seconds to make sure that you answer to get the appropriate information, or the CPE. I also want to remind people or let people know there's a slide deck and handout widget on your screen, and if you click on that, you can download the slides, and you can download our recently published year-end tax update, and you can also update our Tax Cut and Jobs Act summary from earlier in the year. So with that, I'm going to close up the polling question. And what do we got? So 60% are still most concerned with tax reform changes, plus another 10% of the people worried about the international changes within tax reform. We hear that a lot. We're talking to a lot of our clients about these changes because it's different and it's going to require some different information. So with that, I'm going to turn it over to Seung, who's going to cover some of those changes in our federal update. Seung?
Thank you, Rich. Hi, my name is Seung. I'm a tax partner in our Silicon Valley office, focusing on technology industry. As Rich mentioned, going back last year around this time, I think the finance community or business community in general were having a heated discussion on, hey, would this tax reform that was proposed would ever be enacted? And, like around December 22nd, right before Christmas holidays, the tax reform has been passed and is enacted into law. And during that time, a lot of people like myself and Rich and other people were digesting the information and how to account for some of the key changes provisions that are in effect for 17 and also for 18. Now, moving forward another 12 months, as Rich mentioned, I think there are still a lot of areas that are gray, and we're still digesting and understanding, what it means from taxpayer perspective, how it's going to be reported, and if there is a nuances or gray area, how do we account for that? So there are still challenges that we see, especially on an international area. And so we expect in the next 6 to 8 months before the filing of a 2018 tax return, there will be some clarifications on the regulations, issuances, or issuances of form, and those form can provide a little bit of guidance in terms of how it's going to be reported and reflected. So next 3 or 4 slides, we're going to talk about some of the changes that are in effect from an international operations standpoint. But before we go there, prior to the tax reform, you can divide the territory of your operation between U.S. and your operations and overseas through your subsidiary. Generally, the tax rate in the U.S. was higher at 35%. And a lot of your operations overseas, due to some of the changes in their tax rate, a lot of countries were in mid-20s or low 20%. Now, after tax reform, U.S. tax rate is now 21%, so it equalizes some of the tax rate among U.S. and foreign territory. So what does that mean if you still have an operation overseas? For your technology company perspective, do we still need to account for some of your operations and intercompany transactions? The answer is yes. And I view this as U.S. still are imposing the carrot and stick methodology. So if you are doing a transaction or that impacts cash flow out to U.S., then U.S. tax rule would still want to tax or provide additional limitation on the deduction that you can get. If you are having income stream from U.S., then they're trying to favor you by providing a lower taxes. So the first provision on the stick is so-called BEAT. So BEAT is base erosion and anti-abuse tax. So think of it as a replacement of your minimum taxes. How it works is it applies to a company. At least you need to have gross receipts of $500 million in average 3 years. And the intercompany transaction or expenses that you incurred for that taxable year has to be 3% are related to the related party payments that's subject to the BEAT. So if you meet both criteria, the rule would force you to recompute what your taxable income is under the BEAT, and they would assess 10% minimum taxes. Now for 2018, that rate is 5%, but that rate would gradually increase. So by the time 2025, that rate's going to be 12.5%. So, a lot of people heard as a part of a tax reform, the corporation, there is no longer an AMT provision. However, in an international context, and if you have a related party transaction with your so-called controlled foreign corporation, your subsidiary, then you still need to consider this minimum tax provision under BEAT. Now, so not all intercompany transaction-related expenses are subject to BEAT. There are some exceptions to it. So I think the test that you have to think about is, do I have $500 million of gross receipts in the last 3 years? And whether that related party deductions that I generate is more than 3% of my total deduction. So, so the suggestion is go back and look at your transaction flow, and if it's applicable, then you have to account for it in 2018. Now, similar to other provisions we're going to talk about, the regulations that are still pending, and then the form is still pending. So, we believe in the next 4 to 6 months we'll get a little bit more clarity as the IRS and taxing authority are requesting comments among the tax professionals to how to account for and how to clarify some of the areas associated to BEAT. Moving on to GILTI. So GILTI is, as the acronym assumes, it's a stick provision, right? Similar to BEAT. If you're doing certain things outside the United States, there will be additional taxes compared to your regular taxes that you are picking up, right? So, for technology company perspective, GILTI provision, we expect it's going to be applicable to the most of our technology company because it's a provision where they're going to look at if your foreign subsidiaries operations are mostly service related, and by how the code is designed, most of those incomes you generated by your CFCs are considered GILTI income. So outside of a U.S. income, if you generated income that's subject to GILTI in foreign territory through your subsidiary, that gets picked up in each year. So in addition to BEAT, GILTI needs to be considered. Foreign derived intangible income, so-called FDII, is a carrot provision. So it works against the GILTI provision. So this provision is designed in a way that if you are selling property or performing services to your foreign customer, that income stream that you generate is subject to low taxes than 21%. So by design of the mechanical computation, I believe that the tax rate for FDII-related income, it's going to be a lot lower than 21%, around 13% currently, and then that rate's going to change in a future period. So looking at BEAT, GILTI, and FDII, the provisions are there to mostly favor the U.S. corporations doing business directly to your customers in foreign territory, generate those income in U.S. and tax at 21%. However, if you are doing an activity to shift that 21% income to a different rate, or that profit is generated in overseas, they provided additional provisions to penalize the company to the extent favoring the company in the U.S. doing all business directly by the U.S. parent company. So just to wrap up, so what does that mean if you have not triggered any BEAT, GILTI, or FDII? If you are a regular operating company generating income in U.S. and also generating income through your subsidiaries in overseas, one thing that, the 2017 tax return calendar year company that you had to do is cleaning up your foreign earnings. So by cleaning up your foreign earnings, reflecting if you had a positive earnings as an income in the United States, that levels any further income that you generated from your CFCs, and those incomes are not tainted for purpose of a Subpart F provision or GILTI provision, then those money coming back to the U.S. would be tax-free. So with regards to the international provision, the whole concept has been changed in how we look at the international operations. The takeaway is look at your current business structure, look at your transfer pricing arrangements, look at your how you're invoicing your customers. All of those things may provide additional tax savings or a detriment. So I think this is a good time for you to kind of consider that. Now, moving on to the domestic side of fringe benefits and entertainment expenses, we would also want the company to revisit the entertainment expenses and meals expenses associated to it. Historically, the meals and entertainment provisions, generally, it's 50% deductible to the extent that it was associated to the trade or business. But now they carved out some of the entertainment expenses to be non-deductible, 100% limitation. The meals are still at 50%. So it is carefully, you might want to figure out, okay, what costs are associated to the meals and what costs are associated to entertainment, and track them separately. So if you are especially a tax-paying company, that is something you might want to focus on before you close the book. Now, a lot of companies in tech industry also provide meals for their employees, for convenience of their employees in-house. In the past, those amounts were considered deductible. Now, post-tax reform, those amounts are 50% deductible, and after 2025, those would be no longer deductible. So that would definitely have an additional impact on how these meals are provided on-site and on-premise. Moving on to executive compensation. This provision applies to the publicly traded companies in the technology sector. The historical rule was any compensation that you provide to highly executive officers, covered employees so-called, are limited to $1 million deduction. Now, one of the exceptions to that $1 million deduction threshold test was performance-based compensation. And in technology industry, that performance-based compensation generally means stock option-related compensation. Now, after the tax reform, 2018, what you have to consider is the definition of a covered employee has been expanded. So if you are CFO of a publicly traded company and you receive stock option as a part of your compensation, those amounts need to be considered whether it goes over the $1 million deduction threshold. Second, if you also had some of the option grants or performance-based compensation that was exempt, there is a grandfathering provision, so you might have to look at and make an legal determination. Any compensation that was binding before November 2nd would be not part of this test, but if you can't get over that qualifications, then those amounts also need to be considered as a part of this executive compensation limitation consideration. Another provisions that company overlook is interest deduction. The previous rule, as long as the interests are incurred and then the underlying instrument is considered debt, not an equity, typically those interests are deductible by the corporation. The new tax reform provided a base limitation against that interest deduction. One thing to bear in mind is this is not to permanently limit your interest. It suspends for you to taking on a deduction if your 30% of an adjusted income is lower than the interest that you incurred. Now, how do they define that adjusted taxable income? From 2018 through 2022, consider that as EBITDA. After 2022, then that adjustment needs to also take into account of a depreciation amortization adjustment. So the base threshold of that 30% would be smaller post 2022. So there's also careful considerations need to be taken in terms of how much interest you're generating and how much interest should be deducted in a current year. So we quickly kind of talked about some of the provisions that impacts the international operations, some of your existing meals and entertainment, interests associated to your financing activity for technology industries. But there are some other provisions that you would also want to consider before this year end. And one thing is revenue recognition. There were changes in the revenue recognition for GAAP purposes. So the logical question that occurs, what do we do from a tax standpoint? There are a lot of discussions around, can we conform to the book method? Do we still need to be under a different method for tax purposes? That creates a lot of complexity, and there were some guidances or procedures issued during the mid-year, but not every conformity to the book is automatic. So if you need if you are considering to adopt the book method, a careful consideration is to be needed whether you can really do it automatically or you need a consent from IRS to do it. After December 31st, a lot of your employees would be getting W-2s, or your contractors would receive 1099 if services are performed to your corporations or company. The due dates has been changed. So that was effect last year, but we just want to remind the audiences the due date for that is January 31st, regardless whether it's a paper reporting or electronic reporting. So make sure those are done on a timely basis. If you are a small business, then there are some additional provisions that you can take into account for your accounting methods. The cash basis taxpayer, that threshold is increased to 25 million gross receipts. So there are some provisions that would help some of the small businesses to simplify their accounting methods. So that is available. If that fact pattern meets, then you can consider it as well. The last thing is bonus depreciation. The company can still take into account of a bonus depreciation for 100% expensing some of the qualified property that was placed in service. So some of these provisions would definitely help you lower your taxes for the current year, but do consider the timing element. And if you have any other questions with regard to federal tax law changes, please talk with your tax advisor immediately. Rich, I would convert it back to you for the poll question.
All right, thanks, Seung. That was great. But rolling into our next polling question, as we kind of turn our way to the state changes, how many state tax returns did you file for 2017? So we have 4 options there. I just want to reiterate, Seung did a great job of going through a number of the most common provisions, but these are by no means exclusive. As I mentioned before, you can get more information in the slide deck and handout widget. We also have some questions coming in, and if you have any questions, I'd like to remind people to use the Q&A function. So, Seung, as I'm waiting for people to respond, I'll wait a little bit more. One question did come in that I thought was interesting. If I take my finance department out for dinner at the end of the audit, is that meals expense 50% deductible or not?
That's a good question, Rich. I think, under the new reform, you have to carefully consider what the purpose of that expenses were, right? So if there is an element that it is entertainment, right, not necessarily for the convenience of your department, and having the meal on premise, there could be viewed that as an entertainment expenses and it's non-deductible, right? So, that would be my take, and I don't know what Rich, your thoughts are for that.
Yeah, no, I would agree. I mean, you have to focus on is it for the convenience of the employer. So, if you're celebrating the end of an audit, that seems a little bit different than you're bringing dinner because everyone's working late. But that's on a case, a facts and circumstances test each of those. So, but be aware, the IRS and Congress is going after this area. With that, we're going to move on to the second part of our agenda, and I'm going to turn it over to Adam Cline to give us an update in the world of SALT. Adam.
All right. Thanks, Rich. So when it comes to state and local tax for technology, communications, life sciences companies, a lot of the focus here is going to be on indirect taxes being a lot more of the trend and the bigger issues that we're seeing. So I'll spend a little bit of time on the front end of the SALT section talking about the imposition of sales tax on digital services, software as a service, and things of that nature. Once upon a time, it used to be from a sales tax perspective that you had to have a sale of tangible property in order to have a transaction be subject to tax. That just isn't true anymore, especially in this day and age where many forms of software and software-related services are delivered via the cloud, and the states are myopically focused on how they tax that. And so it's something to be very aware of, especially in light of the new Wayfair decision that came out, as Rich alluded earlier this year, of how Nexus and sales tax will intersect. So a quick look at this slide just with respect to cloud computing. That tends to be kind of a broad term, and it's important to get into the details of, are you providing remote access to software? Are you consuming your software in the form of providing a data processing service to a customer? Are you providing automated services? Are you providing hosting services? These things are all very important considerations. A quick note that you don't look just at the states. You have to sometimes look at the cities. The city of Chicago is no exception in that it has a semi-recently enacted tax that applies to a lot of cloud-based services, including many forms of software as a service and some automated services. So something to be very keenly aware of, especially in light of the fact that the state of Illinois does not impose currently sales tax on software as a service and a lot of data processing services. So city of Chicago can be a gotcha moment in a lot of facets, and a separate tax authority that has to be dealt with respect to compliance and tax returns. Kind of moving on, Tennessee is another state that has semi-recently enacted some changes. We're just starting to see enforcement in that Tennessee now imposes sales tax on software as a service. And again, it's very, very important to dig into whether the type of software that's being provided into customers that are located in Tennessee as to whether it meets those definitions. Again, software as a service is kind of more of the umbrella term, but you have to really dig into the details, and it's important to trace through contracts and statutory guidance and administrative guidance in order to determine whether the types of services or provisions of software really do or don't meet these definitions. New York takes the position that cloud computing is a taxable license to use remote software. That's important because you won't find that in statute for New York. You'll find that in administrative rulings, whereas in Washington, you will find in statute that remotely accessed software, cloud-based software, and digital automated services, which are a form of consuming your own software to provide an automated service, are specifically enumerated as being taxable by statute. So you have this wide array of different ways you get there through looking at the guidance. Continuing on, state of Texas takes the position that not only is remotely accessed software subject to sales tax, but also data processing services, which is very widely construed to basically be any sort of software type of service that is provided through the use of software. So if you have services that are being performed that are automated in whole or in part, and you have customers located in the state of Texas, this is a very important provision to look at. Texas, with its data processing services exemptions, the impositions tend to be very, very wide, and there's very few exceptions. There are some, but it's something to be aware of, and Texas is a fairly aggressive state. And again, on the question of is it SaaS, IaaS, or PaaS, these different definitions are pretty important. Some states like Texas, it may not make much of a difference in the classification, but other states like Tennessee, or in some cases Massachusetts, you might have one type of cloud-based service that's subject to tax, but another isn't, and it's really important you look at that contract language. There's also an expansion of imposing sales tax on just plain services. Hawaii, New Mexico, South Dakota, and West Virginia are good examples of states that impose tax on transactions beyond just merely tangible property and various forms of providing software, cloud-based software solutions and things of that nature. That things to be aware of with respect to these states are that these sales taxes operate much more like a gross receipts tax in that they apply across a broad base. And so, again, in the beginning of the presentation on the SALT section, I said we're moving away from only having tangible property be what sales tax is imposed on. It's becoming wider and wider and wider. And even professional services such as accounting services can be subject to sales tax in South Dakota. That net is just that wide. So things to look at. Some states take the position that a business-to-business type of transaction is exempt from sales tax. You have to look state by state to see whether that is afforded. That tends to be more in the digital products arena, where you have downloaded music, downloaded books, downloaded videos, things of that nature. But it can apply in some other facets. That generally, if you're selling those types of items and you have nexus in a state and the state taxes those types of items, you would be expected to charge sales tax and only not charge sales tax upon receiving appropriately executed exemption certificates from the buyer, but something to be aware of. Now getting into Wayfair. Rich touched on that first. I touched on it a little bit as being tied into looking at taxability. On June 21 of this year, the U.S. Supreme Court heard and ruled on the Wayfair decision, which at the end of the day was a view of the South Dakota law of saying that an out-of-state remote seller, such as Wayfair, selling furniture into the state to state residents, whether South Dakota could enforce Wayfair to charge sales tax when Wayfair's presence was merely economic with the state, meaning that it wasn't physically present in the state at all. And it was ruled that that provision, that statute by South Dakota, was constitutional, meaning that a state, and this opened the door, that a state may force an out-of-state seller to charge sales tax when its sales into the state meet or exceed a certain threshold, or it has a certain level of transactions that it meets. It would be required to file a sales tax return and collect and remit sales tax. This is going to be extremely burdensome and a fundamental change for many companies that don't have or have historically had a physical footprint across the country, because merely meeting the requisite sales thresholds across the country into various states that have adopted, since the Wayfair decision, Wayfair-esque types of Nexus provisions is going to dramatically increase sales tax compliance. Now, as I'm sure many of you are thinking with the earlier slides in the SALT section, what do I need to actually charge tax on? Well, that's where the taxability of the services and products that are being sold is so important in all this, if not for purposes of determining whether you're subject to any of these Wayfair tests, but also if you are, whether you have to charge tax and be filing a return and be going through the rigmarole of collecting and remitting and having all of those controls in place. So as I said, physical presence is not a requirement for having Nexus in the state, and you look exclusively at these thresholds. So in the South Dakota example, that was part of the U.S. Supreme Court case. The sales threshold is $100,000, and the transaction threshold is 200 or more separate transactions. So that's all you need to meet in order to have Nexus in South Dakota and start to collect and remit sales tax. The Supreme Court viewed these thresholds as a safe harbor. The safe harbor being that if you don't meet the thresholds, you don't have to file. I think it's probably up for debate as to whether that is really much of a safe harbor, but it's deemed the safe harbor nonetheless. One of the other reasons why the U.S. Supreme Court had ruled in favor of the state is that South Dakota happened to be a member of the Streamline Sales and Use Tax Act, which means that it shares common definitions with other member states. There's 24 states that are members of the Streamline Sales and Use Tax Governing Board, and that there is a requirement under Streamline that the state provide for free some level of sales tax compliance software to be used. Now, in practicality, that software usually isn't all that usable, and it's difficult to use, and there are many differences that can be amongst Streamline states. So the fact that they might share some common definitions does not mean by any way, shape, or form that those states are going to have the same imposition standards of sales tax across the country. So you might charge tax in one state that's a Streamline member, but you might not for another, because the states can still determine what is or isn't subject to sales tax. You just might have more common definitions of what is tangible property and things of that nature. So just kind of something to keep in mind. Even though it became part of the indicia for the U.S. Supreme Court justices to decide, it nonetheless doesn't make the compliance, frankly, that much easier. This slide just goes over a quick little caption of some of the varying thresholds. As soon as the Wayfair decision was decided, the states, like wildfire, through their legislature or through administrative guidance, pending how comfortable they were with their existing statutes, started enacting or at least reporting to the general public that they intended to enact some Wayfair-esque type of standard. And so these thresholds across the country, $100,000 tends to be the most common, with being a mirror image of the South Dakota standard. But other states like Georgia is $250,000, Massachusetts is $500,000, and also has what's called a cookie standard, cookie with respect to software and digital items residing on your computer or server. And the effective dates are all over the place. However, that being said, many of the effective dates went live October 1, and so a lot of these standards are already out there. So with respect to that, approximately 28 states have already adopted some form of Wayfair Nexus, which is encroaching because there are 5 states of the union that don't have a sales tax. So it's definitely more than half and encroaching, and by January 1, we expect to at least know of all the states that will have Wayfair standards and what those will look like. this comment here, Nexus studies will soon be out of fashion. Nexus is becoming a lot easier, but with respect to the second part of that comment, taxability studies are the new black. It's just so important to understand what you're selling and what's being sold inbound into the states, what's its character, and to what degree is it or is it not subject to sales tax. Exemption certificate inventory and control is going to be a hot topic that we expect to come into play, because with the advent of having to file in many more states where you have wholesale sales for which perhaps some taxpayers have relied that they didn't need to charge tax because those sales were exempt from sales tax by virtue of being wholesale, if you have Nexus in a state and you've not contemporaneously collected resale certificates from your buyers, that could be an issue that comes up on audit, because the presumption is always a taxable sale, a sale that's otherwise subject to sales tax, is deemed to be subject to sales tax inbound into the sale, and that you have to prove that it was a wholesale sale, and that proof is by demonstrating that you had an exemption certificate. There can be some timelines to fill in and collect documentation after the fact, but we expect the states to start to focus on that a lot more. Themes and trends. This ready, fire, aim approach seems to be what the states are doing, and that guidance is getting out there very, very quickly, and it's not always clear how well thought through it really is. So getting into a couple of maps to paint a picture of where some of the effective dates have come in. This map gives just kind of a basic idea of some of the economic presence and where the states have started to enact or will soon enact the Wayfair Standards of these thresholds. What's been very interesting in this process is that some of the largest states of the union from a population perspective and tax department perspective, such as New York and California, have not historically to date really made clear what their standard will be. California has started to make comments about what its standards might be, but only very recently in the last roughly week. New York has still not made a comment about what its Wayfair standard will be. That's a little problematic of just not really knowing what they're going to do. This gives a snapshot of how many states had come online with respect to enforcing Wayfair standards prior to October 1, 2018. There was a lot of activity of states saying what they were going to do, but the actual effective dates were more often than not October 1 or later. So here's October 1 coming online. November 1, you see a few more coming online. December 1, a few more. And January 1, even more. This gives another kind of slice of looking at some states that have a few other different standards and implementing what's called some cookie provisions, of which Massachusetts is the front runner, in that a cookie, as in the software context, is deemed to be tangible personal property. If that's residing on your computers or servers, it's deemed to be physical presence in the state. So if you have that and meet the $500,000 receipts test, you have Nexus under Massachusetts standards. Those provisions are important to understand because those states might take the position that because the cookie part of the test is a physical presence test, they might be able to enforce Nexus prior to the effective date of Wayfair. That's really important because we generally expect these pure Wayfair standards that are purely economic based, that they won't be enforced prior to June 21 of 2018, which was the date of the U.S. Supreme Court decision. So those are important nuances to consider. More on cookie states. In determining thresholds, these are important things to look at with respect to what you count. Some states look solely to retail sales of tangible property, which a retail sale means B2C, that you sold to a consumer. If you have a state that has a broader definition that might include wholesale sales or might include any sale that would otherwise be subject to sales tax, it might pull in certain services that are remotely accessed software, data processing services, telecommunications services, lots of things that are up for debate right now that remain largely unknown with how fast these provisions have gotten rolled out and how little guidance there is out there. Home rule locals, this is going to be another issue that we expect to be popping up more often than not. There's a few remaining states of the union that have cities or local municipalities that separately impose a sales tax incremental to the state. As to how those localities are going to impose Wayfair standards, that's still up for debate in large part. Further state implications, stepped up Nexus enforcement from the states. This was a gift to the states, and we expect them to take full advantage of this. We will likely see kind of an abandonment of a myopic focus on physical presence being the Nexus creating standards, but physical presence will probably still play a role to some degree, especially if there are findings of physical presence and not a finding of economic nexus presence, where the state can create nexus or demonstrate that the company has nexus either way. From an income tax perspective, just kind of some of the takeaways here. Wayfair was a sales tax case, and it did not directly address income tax. It kind of remains to be seen exactly how that will play out. There's been some large taxpayers that have been in the news that have been taking positions in their provisions that Wayfair applies to state income tax nexus to some degree, and there may be a place for that, but there's a lot that remains unknown in terms of exactly how that would work out and how that would apply and what the states will roll out as far as guidance. Keeping in mind with all of the sales tax economic nexus out there, the Ohio Commercial Activities Tax and Washington B&O tax have economic nexus provisions that have existed far before the Wayfair case had come out. So.
All right, Adam, thanks. I'm going to jump in here on the next polling question. So based on what Adam has said, and especially that last comment, how many more states do you expect to file in as a result of Wayfair and some of these state law changes? So we'll give everyone a few seconds. Adam, a question did come in, and that is, are the Wayfair thresholds on a per-year basis? On a per-year basis?
Yes, they're on a per-year basis. You have to look state by state. More often than not, you're looking at the previous calendar year. So if you're looking at a state that's effective 10/1/18, you're looking at your 2017 calendar year sales to see if you meet it. Some states look at the previous calendar year or the current year, so you just have to look state by state. But it is an annual test.
All right. Thank you. All right, now we'll wrap up this polling question. So yeah, some, about 2/3 are going to be filing in additional states, which I think that seems about right. Whether it's Wayfair or just other changes, not directly tied to Wayfair, is creating additional filing responsibilities. So with that, Adam, I think you were going to touch real quickly on a few other California-specific items.
Yeah, that's right. Now I'll just briefly go over these. California has some proposed regulations on market-based sourcing. I think they're really important to read because they're not always terribly intuitive. This slide covers research and development services for a situation where you'd have, say, a life sciences company that's running clinical trials, and that it's really about where the benefit is received. Benefit is deemed to be received where the clinical trials are being run is kind of the takeaway. A lot more to be developed there that we'll see. And continuing on market-based sourcing with respect to intangibles, you have to look very carefully at the contracts in terms of whether you're receiving upfront lump sum payments and the licensing. And the general rule of thumb is that the intangibles are generally sourced to where the intangibles are used. You got to really carefully examine your contracts and where the intangibles might be used by the customer or a third party and things of that nature. So something to focus on very heavily, especially with how big the California population and deemed users might be. Back to you, Rich.
All right, thanks, Adam. We want to throw those California changes in because California either do to the technology industry or just due to the population size, it affects most companies. So it's always it always needs to be watched closely. So the polling question, last polling question, what concerns you most with tax provision accruals and disclosures? So inherent in here is that you have a tax provision accrual and disclosure. And is it just keeping up with the changes of the Tax Reform Act? Is it the actual calculation in and of itself, getting the current and deferreds right? And is it the disclosures that you need to include in your financial statements and how they correlate with the other GAAP accounting standards? Or is it all of that? Just trying to get a sense of where people struggle. So we'll give everyone a few more seconds. A reminder to, if you have any questions, use the Q&A. We still have a few in the queue we'll try to get to. If we don't get to them all, we will follow up specifically with you on your questions. All right. So keeping up with all the changes is the leader there, almost half. And about a third is everything. So we understand it's a complicated area, and I'll turn it over to Shannan to kind of give an overview of things to remember and think about during this as you wrap up your 2018 financials. Shannan?
Thanks, Rich. So we'll just spend a few moments here, the remainder of our time, just talking about just tax reform and some things to keep in mind as you're going through your financial statements, and also just some things that are on the horizon from a GAAP standpoint and how you need to consider those as well with respect to your tax provision. So if you recall at the end of 2017, when the Tax Reform Act was passed, there were a lot of companies that had to deal with a lot of very complicated provisions very quickly. And one of the things that companies were allowed to do is rely on SAB 118 and disclose a provisional amount with respect to the impact of tax reform. And that provisional amount that was disclosed was allowed to be maintained as a provisional amount for the 12-month period beginning in December of 2017. So as we're wrapping up financial statements for December of 2018, companies now are at the end of the period where they do have to conclude on those provisional estimates if they haven't done so already. And there are some additional disclosures that you're going to need to keep in mind as you're going through this process. You are required, when you did have a provisional estimate, you're required to disclose the nature and the amount of the estimate that's now being finalized and the effect of that on your effective tax rate. And just the fact that you are closing out that estimate, that you're now complete with respect to your analysis of tax reform and the impact to your financial statements. So that is something that is going to be just an additional thought as you're going through your footnote disclosures for 2018. The other thing to keep in mind is the impact of tax reform for your valuation allowance analysis. So to the extent you've got a valuation allowance on your books at the current time, looking at some of the provisions that Seung talked about earlier and whether or not any of those provisions will have an impact on your analysis. One of the things to keep in mind is the net operating losses generated in 2018 will no longer have a carryback provision. They'll have an unlimited carryover, but they're only able to offset 80% of your taxable income. So those types of things are things that you need to build into your analysis. The fact that your interest may not be 100% deductible or that you might have an income inclusion under GILTI, those are all things to consider as you're looking at your valuation allowance analysis. One of the items that I did want to mention is some of these international provisions, even if you don't think that they're going to be material, many of the financial statement auditors that I have worked with have just requested that companies provide some sort of support that shows that you've done the calculation and that you've performed at least a high-level analysis of what the impact of some of these provisions might be, so that they're able to audit that and agree with your assessment that that is or is not material to your financial statements. The other thing that Seung had mentioned is that as companies are going through the revenue recognition adoption, you really need to consider what the impact might be on your tax return and your tax provision. So for public companies, the ASC 606 is being adopted in the current period in 2018 for calendar companies. For private companies, this will go into effect beginning with your 2019 year for calendar year companies. And the tax reform provisions under 451 have made it such that there is some conformity to some of the book provisions in that we're not able to defer more than books has deferred unless you're following certain provisions with respect to service-related income. And so really making sure that as you're going through your GAAP analysis of the impact of 606, that you're also considering and talking with your tax providers about what the implication might be from an income tax standpoint, because you may have to file a 3115 and request a change in accounting method, and that might not always be an automatic change, so that could be something that would need to be filed by the end of the year. So if you're not having those discussions, super important to begin having those at this point in time. On a similar note, we do have some changes for GAAP in the accounting for leases as well, where there'll be more leases that are going to be required to be capitalized for book purposes. There's not been a change in the operating versus capitalized leases for tax purposes, so you might see more book tax differences, and so that's just something to keep in mind. If you are seeing a change and you've historically used your book fixed assets in your apportionment factor, as those start to get capitalized, you might see some impact to the state factor, and so that's something to keep in mind as well. And again, for public companies, this will impact your 18 calendar years, and for other companies, it would be for tax years beginning after, for public companies for 19, and for other taxpayers for tax years beginning after December 15th, 2019. The other impacts of tax reform, to the extent companies have deferred tax effects sitting in other comprehensive income, is that with the release and the change in the tax rate that those deferreds are measured at, the way the ASC 740 rules work is that change in tax expense automatically goes through your tax expense from continuing operations. What that creates is this residual effect, tax effect that's left sitting in OCI. So one of the things to consider is that for tax years beginning after December 15th, 2018, companies do have the ability to adopt ASU 2018-2. And what this allows you to do is to reclassify that tax impact that's captured in OCI and pull that out and reclassify that to retained earnings. And you are able to early adopt this provision. So if you do have other comprehensive income in your balance sheet and you are seeing a disproportionate effect that's lodged in your OCI, this is something definitely to consider because you may reclassify that out of retained earnings. There is some additional disclosure to consider as well. You are required to make a statement that says you did reclassify the income tax effects out of OCI and a description of the other tax effects of the Tax Act that have been reclassified. And then companies that don't elect to reclassify the income tax effect of the Tax Act should also disclose that as well. So you should have a disclosure either way, depending on the choice that you make. The other tax provision item to consider for companies that have intercompany transactions that are crossing different jurisdictions is historically those deferred gains or losses, or those gains or losses between intercompany transactions are deferred in consolidation. And historically, the tax impacts related to that were just deferred as well. and were required to be amortized in the same fashion as the underlying asset. So if you had a gain or loss for an intercompany transfer of fixed assets, for example, that would be required to be deferred in your consolidated financial statement, and the tax impacts related to that would also be required to be deferred. So ASC 2016-16 allows a company to recognize the current deferred tax impact currently, and so that is something that might alleviate some of the complexity in accounting for some of these intercompany gains or losses. This is applicable for public entities for reporting periods beginning after December 15th, 2017, and for all other entities for tax years beginning after December 15th, 2018. I think the key in all of these items as you're thinking about tax reform and what to provide to your auditors is really making sure that you're documenting that you've considered the impact of tax reform, because I think that's going to be important as you're looking at your financial statement audits. Rich?
Thanks, Shannon. That was a great summary of some items that often may be overlooked, but your external auditors may be asking for. I know I'm getting these questions already, and we're trying to document the support that we do for our outsourced tax provision work. If you have any questions, don't hesitate to reach out to any of us on the call or your individual tax advisor. We're always happy to help. With that, we're at the top of the hour. I want to thank everybody for joining. And if you have any questions or even suggestions for future webinars or alerts, also reach out. Thanks, everyone. Have a great day.
All right. Thank you, Rich. And thank you, Adam, Shannon, and Seung, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download this now. A copy will be emailed within the next 2 weeks should you have any difficulty downloading it now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.